On today's episode, we're going to review mortgage rates, why they are the way they are right now, go over some key economic data and reports that have happened over the past week. Then we're going to explore what does it take to afford here in northern New Jersey after the New Jersey realtors have released the median sales price per county. And for our Did You Know segment, part 2 of tapping into home equity, and we're focusing on home equity lines of credit. Let's get into it. Welcome to Mortgage Markets and More. I am your host, Peter D'Angelo from Rate. I hope you're doing well and happy Valentine's Day, everyone. Unfortunately, the market isn't feeling the love, particularly this week. So there's a lot we're going to be talking about today. I'm just going to get right into it with our normally scheduled survey of mortgage rates according to Mortgage News Daily survey as of recording this podcast the Thursday morning before its release. Starting off with our 30-year fixed rate mortgage, we are now averaging 7.13%. The 15-year fixed rate mortgage is averaging 6.5%. The 30-year jumbo is averaging 7.45%. The 30-year FHA mortgage is averaging 6.52%. The 7/6 SOFR adjustable rate mortgage is averaging 7.25%. And I wanted to make note today, the state of New Jersey offers police and fire loans for first responders. That interest rate adjusts twice a year, and the next adjustment will be occurring on February 17th, and the interest rate for those police and fire loans is going up to 5.49%, up from the current level of 5.04%. Across the board, higher interest rates. This all occurred pretty much within, as of when you're listening to this podcast, within the past 48 to 72 hours. The bond yields, let's talk about where they're at. The 10-year Treasury yield is at 4.594%. The 5-year Treasury yield is at 4.446%. And the 2-year Treasury yield is at 4.338%. Across the board, everything is elevated. Why did this happen? Well, we're going to get right into it. First, just to remind everyone, we got the personal consumption expenditure we talked about in the last episode, spot on in line with expectations pretty much across the board. So the Fed's preferred inflation gauge was consistent. Now we have the CPI report, and that's really what did the damage. But before we get to that, let's talk about the good news that happened that started out this week, and pretty much all of this came to a halt on Wednesday. Last week, we got the employment report, for January of 2025 to kick off the year. What that report showed was non-farm payrolls missed by just about 30,000. So there was 143,000 jobs added in the non-farm. So this is nothing related to agriculture. Unemployment rate came down to 4%, and it was 4.1% as of the last reading. So that's good news for the labor market. Average hourly earnings also outperformed with wage growth 0.5% month over month, just slightly above the 0.3% that was expected. Labor force participation rate was at 62.6%, and the expectation was 62.5%, so we did better there. Private payrolls, tongue twister today, was 111,000 jobs added, and that missed the expectation of 158,000 jobs added. When we look at the whole picture, the labor market is showing strength, though the additional jobs added missed the expectation. Unemployment went down. Overall, we can take that as a strong labor market. Even though we had some misses there, the market reacted positively, and we saw interest rates continue to come down as we ended off last week and started out this week. Then came Wednesday. Wednesday, we got the Consumer Price Index, the second inflation gauge that we look at and that the Fed looks at, even though it's not their preferred. That came in hot, unfortunately. So the core, this is removing volatile elements from the data set to give us, hopefully, a truer picture of cost increases, came in at plus 0.4% month over month. That's compared to 0.2% that was in December. Now, annualized core CPI came in at 3.3%. That was against the expectation of 3.1%. And to remind everyone, the Fed's target here is 2%. So the pendulum has now swung squarely above the 3% threshold. We were hoping for at least meeting expectations. For context, January, particularly over the past couple of years, has always shown hotter inflation. That begs questions on whether or not the numbers need to be adjusted, and this is something that is worth consideration because a lot of these things are seasonally adjusted. Maybe the seasonality is changing. So these are some things that Wall Street analysts have been discussing and that I've read about since Wednesday. But the point remains, inflation is hot, and it came in much hotter than expectation, and the market reaction was extremely negative. To give you the full headline, so this is now not removing the volatile elements like food and energy, that came in at 0.5% growth month over month. So 0.5% price hike, and that was against the 0.3% growth that was expected. Because of this hot inflation report, the bond market, as you just heard from our survey, that increased. We were on a downward trend nicely. If you looked at the chart, you saw it just spike up on Wednesday. This then also created a trickle-down effect for mortgages. So mortgage rates also swung higher. Last week, interest rates for a 30-year mortgage were at 6.99%. We were celebrating the fact that for the first time in 2025, we were finally below the 7% threshold. That has now disappeared because of this hotter inflation report. Other than that, let's think about what's ahead and what could possibly start normalizing. Look, when inflation reports like this happen, it becomes a knee-jerk reaction in the market. Understand, too, that algorithms are sensitive and they're programmed a certain way, and a lot of the market has algorithms that are doing and executing the trades, and they set up thresholds. So if there's a little movement, it can become a big movement. What's going to be important here is waiting out to see market reaction as it digests that CPI report, that inflation report. So the point remains this. We have to look ahead to see what's coming over the next week to see if there's going to be any other data that could possibly move the needle, or if we're just going to exclusively be looking for some stability and normalization after the knee-jerk reaction this week for mortgage rates and for the market at large. Next week, we're going to get the producer price index. We're going to get January retail sales. And then we're also going to get the Federal Open Market Committee meeting minutes from their January meeting. The Fed does not meet in February, so we won't have any monetary policy announcements this month. The next meeting is March 18th and 19th. I'll report out on that after that meeting occurs, and we'll see. Currently, everyone's expectation is that the Fed is not going to be changing their monetary policy. With inflation coming in hotter now from the CPI, with, again, a mixed bag employment report, but by and large, pretty strong representation of the labor market based on the data that we're provided, doesn't provide the Fed with any reason to continue cutting interest rates. So they're not going to continue easing their monetary policy. Just this week, Fed Chair Jerome Powell testified in front of Congress, and his commentary in summary was essentially that they believe that their policy stance currently is restrictive enough and has provided enough initial relief through the 3 rate cuts that ended off 2024, and they are going to continue the wait-and-see approach until there's a significant change in the labor market negatively, where they need to step in, and we see inflation cool and start making more progress as a downward trend. They are not going to change. They're not going to change their rate. They're going to keep their policy rate where it is. So that's, unfortunately, some bad news here on Valentine's Day. But again, we always talk about this. Be prepared. Be prepared with knowledge. Be prepared with your numbers. Keep your communication at a high level with your real estate agent and your mortgage advisor, because as you're shopping with a 0.25% swing in interest rates nearly that we just saw that happened in a 24-hour period, essentially, That changes buying power, especially if you're throttling, if you're maxing out what your qualification provides. That's going to be important to note. For our exploratory idea today, I saw a post on Instagram that the New Jersey Realtors Association had released the median sales price in December of 2024 by county and what annual price appreciation that represents. Thinking on this, I said, it would be super valuable. Let's take a look at this survey and then let's break it down to show how much income is required to qualify for these median prices. And I selected a handful of counties that I routinely do a lot of business in here in North Jersey with the families that I assist. So we're going to look at Bergen County, Essex County, Passaic County, Hudson County, Morris County, and Somerset County. And I think that gives you a nice little blend of the North Jersey market. There are some assumptions that I made that I want to make clear as we go through these numbers. I did a past episode that talked about debt to income. We're going to revisit that on a future episode and do another deep dive. But debt to income ratios are a cornerstone of your qualification. And how we derive that is by looking at your gross monthly income, whether you're self-employed or you're W-2 employed. We take a look at your gross monthly income and compare that to the proposed debt of the property, including taxes, insurance, and mortgage insurance if you're putting less than 20% down, and that gives us the qualification ratio. There is some flexibility on this ratio, but for purposes of this exercise, I capped it at 45% debt to income ratio. I also assumed a good credit score in the 720 range, 720, 730 range, because I'm also using the average interest rate that I just reported out on for a 30-year fixed rate mortgage of 7.13%, according to Mortgage News Daily. In addition, the debt to income ratio also includes debt that's on your credit report. These are student loans, car loans, personal loans, minimum payments for credit cards, anything like that shows up on your credit. Those minimum monthly payments or the monthly payments required get added in to the calculation of your debt to income ratio. So for all of these, I added $1,500 a month in monthly obligations outside of your mortgage. It's a little bit high, but I thought that could still be valuable because then you can kind of gauge it. And also, I'm just kind of taking a survey of over the past couple of years what it's been looking like, understanding that people are leveraging credit card debt more because of the price increases for things. We're talking about inflation. So I figured let's just use that as our figure. In addition, mortgage insurance. This is looking at conventional financing. I'm not talking about FHA financing for these examples. So I'm using mortgage insurance with an average mortgage insurance cost. And then lastly, all of these numbers are based upon a 10% down payment. My thinking behind this is that the survey from 2024 by the National Association of Realtors indicated that the average down payment size of a first-time home buyer in the U.S. was 9.8%. So rounding that up to 10%, it's customarily what first-time home buyers are prepared with. So now we're going to actually look county by county what the median sales price was, what that percentage growth was, 12 months, year over year, December 23 to December 24, what a monthly payment looks like for that mortgage all in using an average tax rate for that county. So it can vary. Some municipalities have higher taxes than other municipalities in the county. So I'm just painting with a broad stroke so we can get a sense here. Then I'm going to talk about the monthly income required and the annual income required to support qualification for that mortgage payment with $1,500 a month in additional debt. So here we're going to start off. We're going to start off in Bergen County. The median purchase price in Bergen County as of December 2024, according to the New Jersey Realtors, was $765,000. That median price reflects 11.6% price appreciation. The monthly payment with the 10% down for that property, for that median price, is $6,068 per month. That would mean you would need to have qualifying income monthly, $16,818 a month. That translates to just a little bit over $201,000 a year to support that purchase. If you have less than $1,500 a month in obligations monthly, then the calculation goes down and you don't need as much income. But that is what you're looking at as a required gross, not your net pay, gross. Moving on to Essex County, $720,000 was the median sales price. That reflects 15.2% price appreciation in the comparing year over year. The monthly payment, though, is $5,894 per month, reflecting a monthly income requirement of $16,430 per month, which is just a touch above $197,000 a year in household income required to qualify. Passaic County, $560,000 was the median sales price. That reflects 9.8% year-over-year price appreciation. The monthly payment is $46.40 per month, and the monthly income required there would be $13,645 a month. Annually, $164,000 a year in gross annual income. Hudson County, $577,500. That reflects 9% price appreciation year over year. Monthly payment for that median home would be $4,690 per month. The monthly income required would be $13,754, and the annual income would be $165,000 a year. In Morris County, the median sales price was $715,000, reflecting 10% price appreciation. Monthly payment, all in, taxes, insurance, mortgage insurance included, $5,883 per month, and a monthly income required of $16,407 per month. Annually, almost $197,000 a year. Lastly, Somerset. Median sales price, $750,000, 13.6% price appreciation. Monthly payment, $6,134 a month, and monthly income required, $16,962 per month. Annual income, $204,000 needed to qualify for that median price. Key takeaways here. You're talking about needing close to $200,000 a year income for these median sales prices in the majority of these counties. The two outliers are Passaic County and Hudson. Some other things to consider too is the blend of condos and things like that. But we're talking single family here, right? Single family homes. All of this paints the picture of the affordability issue, and it gets persisted by the fact that there's less inventory available. These prices keep going up. No county in the survey here was less than 9% price appreciation year over year. So if we say that 2025 is going to be a copy paste, these numbers appreciating in the 9 to 11% range, it's not out of the realm. And we did have an outlier. Essex County had 15% price appreciation on their median home sale price. Somerset County, 13.6%. These are important things to consider as you're shopping. And also, there's a couple metrics here that were set as assumptions. So painting with broad strokes can only be so valuable. Every property is unique. Every town's unique with their tax rate and how much their taxes are, and also your personal financial situation. This is assuming $1,500 a month in other obligations. If you're managing your credit profile prudently, maybe you have a fraction of that as current obligations, which would be great, and that would significantly reduce this qualifying income required. All of that to consider. Still, if you're thinking about buying, even with interest rates being what they are, think about the delta between that. Think about the delta between purchasing now with a 7% rate or 7.25% rate versus purchasing later with maybe an interest rate still at 7%, but the home value is 10% more. It could still be more costly to purchase later. So I'm in the camp that solidly recommends let your personal finances dictate what's going to work best for you. It's not about timing the market, it's time in the market. You hear that from financial analysts all the time. You hear that from wealth advisors, financial planners. That's something to think about. If you get into the market and buy that home, you're in the market. And you can realize that price appreciation because if that's happening around you, that's helpful. Now for our fun fact segment. I heard this on another podcast earlier this week. I listen to Morning Brew Daily every morning. Highly recommend it if you're just looking for a quick 20 minutes every morning of what's going on in the world, what's going on in news, financial markets. It's an awesome podcast I wanted to shout out. And a fun fact I heard on that one, which doesn't have anything to do with real estate or mortgages, but I thought it was interesting nonetheless. According to the U.S. Mint, it costs 3.69 cents to produce a single penny in 2024. So it's a loss making the pennies. We're going to see. There's been some discussions in the current administration about phasing out the penny, but that still remains to be seen whether or not that's possible and whether or not Congress will approve something like that. But when you're looking at the numbers, that's crazy that 1 penny costs 3 times as much to make, almost 4 times as much to make as the value. So there's your fun fact for conversation fodder. Moving on to our Did You Know segment, part 2. We're talking about home equity and how to tap into it. And today we are talking about home equity lines of credit. So what's a home equity line of credit? I normally try to avoid acronyms because my industry and the real estate industry at large is acronym city. There's so many acronyms for things, but for expediency, I'm going to call it a HELOC. So home equity line of credit, HELOC. You will hear people talk about this a lot. So what is a HELOC? It is a revolving line of credit that is tied to your property as a second mortgage, or if you don't have a mortgage on your property, you can still get a HELOC, and that will be the only mortgage on it. And it works similarly to a credit card. You take out a HELOC on your property, and then you have interest-only payments for a prescribed period of time. Normally, traditional HELOCs are around 10 years. So you have 10 years where you just have to pay the interest on the amount that you borrowed. So let's say you get a HELOC for $100,000 and you only borrow $20,000. You're only going to be paying interest on the $20,000. And then it's up to you to make payments on the principal to reduce the balance that you owe. Some key things to note when it comes to HELOCs. First and foremost, they're variable interest rates. The marketplace is wide, but by and large, there are variable rates tied to these HELOCs. So your monthly payment can change. Depends on how the HELOC is structured. How much equity can you tap into with a HELOC? That will vary from bank to bank, investor to investor. Certain investors that we work with here at Rate will allow you to tap in to up to 75% to 85% of your home's equity. Again, a key note for this, your first mortgage and whatever that balance currently is, when you apply for a HELOC, just like the home equity loan we talked about last week, is taken into consideration when we talk about that tappable equity. So you only have access to the difference between your current mortgage balance and 75 to 85% of what your current home value is. How do we find out what your current home value is? That also varies. Some investors, some banks and lenders will offer HELOCs utilizing something called AVM, automated valuation models. Remember what I said about acronyms? So the automated valuation model allows you and allows us to plug in your property address, and if it's been sold or purchased at any point in the past, normally 10 to 15 years, that data is uploaded somewhere on servers, and there's market data and trends, and that is used to determine what the current value is of the property. So if you have accessibility for an automated valuation model, you may not need an appraisal. They may do a property condition report where they send someone out. They're not looking at the property to assess the value. They're just going to make sure that everything's on the up and up with the property, that the use and habitability of the property is consistent with the requirements. That works fine. The other pathway is getting an actual appraisal report ordered, and an appraiser will visit your home, take a look around, take photos, take measurements, look at comparable sales, and derive your current home value. That will drive how much equity you have that you can tap into. I mentioned there's a draw period. You have 10 years. It's interest only during that draw period. That also means you could take more money out. In my previous example, let's say you have a HELOC for $100,000. You only take out $20,000. And then 2 months later, dishwasher breaks. You got to buy new dishwashers. You tap into that. You take out another, $1,000. You can just draw from your HELOC. You take that money out. Now your balance grows. Your interest payment will adjust accordingly, just like on a credit card. And then you'll make your payments. The interest-only period is, like I said, customarily 10 years. After that period, then there's normally a repayment period. So your whatever balance you have on your HELOC at that time, when you reach the end of the 10-year draw period, whatever that balance is, you'll go and you will make fully amortizing payments. And fully amortizing means you're making payment on principal and interest. Meanwhile, the prior 10 years was interest only. So now you have, it can range. It could be 10 to 25 years that you have a repayment phase. It depends on how your HELOC is set up. But then you'll have that, and nothing changes by way of the liens on your property. The lien stays the same. It's just the functionality of the mortgage payments change. And you'll get notification from your HELOC lender when you reach that point to let you know what your interest rate is for that repayment period. And if you have any options to maybe lock in a rate, lock in a prescribed amount of payment, and pick a repayment term. Common uses for HELOCs: home improvement purposes. If you want to do an update to your property, that's one. Debt consolidation. HELOCs interest rates, because they're variable, they range. And typically, as of my research, right now the marketplace is supporting, HELOCs anywhere from 8.5%. With some recent market volatility we just talked about, maybe it's a little higher. So maybe you're close to 10%, maybe even over 10%. That sounds high. Compare that to your credit card statements. Take a look at those credit card bills and what your interest is on those. Sometimes a HELOC makes sense to consolidate those. Emergency expenses. Something comes up. Now you need to tap into your home equity. Having a HELOC established is a super effective way of getting that taken care of. Think about it this way. If you don't need it, that's the time to get it, so that then this way when you do need it, you don't have to scramble. College tuition payments. This is something that's become more and more common. People are tapping into their home equity so that they can make payment for tuition. The pros are it gives you flexibility on borrowing. You get interest-only payments, and you may have some tax deductibility. Talk to your accountant on that. The cons are payments can vary and payments can go up. Anytime payments go up, that's risky. So bear that in mind. Interest rates rise over time. That affects what your monthly payment is. And then if you reach a point financially where you're not able to repay, it could start foreclosure, and that presents a risk. Overall, HELOCs are a great option if you want that flexibility, have the financial discipline to pay down the principal on your own. And also, it's a pretty easy process. I will just tag this out by plugging our home equity line of credit, which is a hybrid of these two. We talked last week about home equity loans. Then we talked today about home equity lines of credit. Our HELOC is a fully online experience that you can do online. You can call me, and in about 2.5 minutes on the phone, I can plug in some information and let you know an initial proposal of what your HELOC could look like, and then send you over those options for you to select. And our funding happens normally within about 10 days. So it's a super fast process. Where we differ is our HELOC is actually fixed rate, fully amortizing, but you have a draw period. So even though your monthly payment's based on fully amortizing principal and interest, if let's say you make a lump sum payment, you may have the ability to have your monthly payment re-amortized, and or you do have the ability in your draw period to take more money out if another need arises. So that's something that's a little different, because what we offer is a bit of a hybrid. And then I do have other channels that I work through to get you traditional home equity lines of credit. So it's good to know what all of the options are that are available to you. That is it for the show today. I hope you found this information helpful and useful. This was a ton of information. I'm going to be breaking it down into digestible chunks as we move throughout the next week. If you follow me on socials, you'll see some videos and some other content posted. Next week, we're going to do a side-by-side comparison of home equity mortgages and HELOCs. And we're also going to see what the market digestion of these new interest rates looks like. For now, I hope you all have a wonderful weekend. Have a wonderful Valentine's Day. Take a moment today. Tell someone that you love them. Somebody in your family, friends, whoever it may be. Celebrate the day of love together. And I hope you all have an absolutely wonderful weekend. Take good care.